I was literally living month to month.
When did you come up with the idea for Haystack?
It started because maybe on 3 different attempts over a 3-year period trying to, quote, get into venture. They kind of pulled me aside and were like, hey, stop looking for a job and just start a small fund and use it as kind of your rap sheet. May of 2013, invested in HashiCorp and Instacart. And in October of 2013, invested in Envoy and DoorDash.
One of the biggest years anyone would have ever had.
Every fund until Fund 5 was always below the target. Fund 4 is where I felt the most fear and pain. It's my little secret.
Are you going to share it or?
It's the best quarter out of the 4 quarters for us to raise.
What is the latest fund?
Core fund of 75 million and a companion fund of 25 million.
Welcome to The Peel, where we explore the world's greatest startup stories. I'm your host, Turner Novak, founder of Nana Capital, the venture capital firm looking for needles in a haystack. Today I talked to Semil Shah, the founder of Haystack, a venture capital firm that backs outlier founders at the earliest stages. Semil started Haystack in 2013 and has since invested in a handful of unicorns like DoorDash, Instacart, Figma, HashiCorp, Ironclad, Carta, Opendoor, and 16 total companies valued at over $1 billion, including markdowns made in 2022. Semil just announced a new set of funds today, sized at 75 and 25 million, to continue supporting outlier startup founders. We'll throw links to those announcements in the show notes, but he'll take us behind the scenes of his 2-decade journey building Haystack from scratch. We talk about juggling multiple jobs while living paycheck to paycheck his first decade in Silicon Valley, failing 3 times to get a job in venture, why he initially thought Haystack would be a short-term thing, and all the pain he felt failing his fundraising target on his first 4 funds, despite today having one of the best early-stage track records of anyone in the Valley. Semil shares all the secrets he learned while building Haystack, including how emerging VCs can increase check sizes over time, how he builds relationships with LPs, the hardest questions he faced raising each of his 7 funds, how to pre-market a fundraise, the traditional fundraising advice that makes no sense today, and his favorite quarter to fundraise. This is one of the very first conversations I recorded back before the show launched. I really liked putting it together, and if you've ever been interested in starting your own venture firm, I think you'll really like this episode. Thanks to Semil for coming on the show, and congratulations on the recent announcement. Now, let's jump in after a quick word from Mercury. Mercury is banking for ambitious companies, a modern partner that says goodbye to the friction that comes with traditional banking. Mercury moves at the speed of startups. From a seamless onboarding to wiring money and providing you with connections in a network, everything is just a few clicks away. Regular listeners will remember we've had Mercury co-founder Amada Kund on the show, and we'll link to that episode in the show notes if you want to dig in deeper to everything they're building. I use Mercury personally, and whether you're a team of 2 or 2,000, I recommend it to every startup and venture capital firm looking for something better. Join myself and more than 100,000 startups and VCs. Head to mercury.com to sign up for the most intuitive way for ambitious companies to bank. A quick disclaimer, Mercury is a financial technology company, not a bank. Banking services are provided by Choice Financial Group and Evolve Bank and Trust, members FDIC. Thank you, Mercury. And now let's talk to Semil Shah about Haystack.
I'm here with Semil Shah. He's the founder of Haystack. Haystack is, in my opinion, one of the top early stage funds, early investor in companies like DoorDash, Instacart, HashiCorp. These have all IPO'd. Company like Figma, which is a real business worth a lot of money. Semil has a really interesting story that we're going to kind of talk through today. I'll let you jump in. How did it get started? Like, when did you come up with the idea for Haystack? What was the moment?
Yeah. And thanks for having me on. And I agreed to do this too, because I think you're going to get into like the sort of meat and guts of it, which I'm really happy to talk about. It started because maybe on 3 different attempts over a 3-year period, trying to, quote, get into venture. It was a tale of 2 cities in one sense, where I knew a lot of VCs personally, and I was even a consultant with a bunch of VCs. So I spent a lot of time with them, and I had a lot of friendships build up, and they helped me a ton. So it was all like very positive. Where it came up short was like, in the end of some competitive processes, or I didn't have like the traditional background. And I don't blame anyone for this, but people would say like, I like you, I want to work with you, but I don't know how to fit you in here.
Were you sending deal flow, and like, were they investing in the companies that you were getting in front of?
A lot for years. And I wasn't coin operated about it. I was like, hey, I was just trying to help people on both sides. So most of the consulting work I was doing was not deal related. It was helping a few partners on projects.
Like portfolio company work or firm level projects?
I would say 60, 70% firm level. And these were all like Sand Hill Road, plus GC type. General Catalyst was one. And they were all great to me. But that third sort of campaign to sort of get a role, it didn't happen, sort of down to like 2 people. I think it was like Thanksgiving 2012. So it was, at that point married, no kids yet, but my wife was pregnant. I've told this part of the story, but 2 of my good sort of industry friends, Nakul Mandan, who used to be a partner at Battery and Lightspeed, now started this fund called Audacious, and then Gautam Gupta, who was one of those wonder kids that started at GC when he was 17. He's now a partner at TCV, Technology Crossover Ventures. They kind of pulled me aside and were like, hey, stop, this is a key line, like stop looking for a job and just start a small fund and use it as a kind of your rap sheet, if you will.
So did you think you were just going to kind of have a small fund and then go get a job at one of these bigger funds, or?
Absolutely. The first 2 years, the first check went out of Haystack officially March of 2013. My first kid, my daughter, was born in April of 2013. In May of 2013, invested in HashiCorp and Instacart. And in October of 2013, invested in Envoy and DoorDash. And I had no idea at the time how consequential that year would be. But
that's a big year. That was probably one of the biggest years anyone would have ever had in early stage venture.
Yeah. And I think the goal, to answer your original question, was to make investments, show that of the flow that I was sending to some of these folks, I could participate in some of the flow.
When you invested in those companies, like, did you help connect the founders to other people that joined the cap table, people that they hired, like help with product? Like, how did that all play out?
Of course. I don't want to overstate the amount of help, but I would say just like what you would do, just sort of basic stuff.
Just whatever needs to be done kind of a thing.
Yeah, I wouldn't say it was backbreaking. I think these are just people I knew. I had known Apurva for a little bit. I'd known Mitchell for about a year, and we had a close mutual friend. His mentor and boss was like a close friend of mine. Tony, I met through Sar Gur, who I have to give a shout out to, who, Sar has been amazing. Just person who shares and is like super deep, shared Tony with me. So that was a great connection. And then Larry, I had known from a previous startup job.
So why do you think these founders took your money?
Well, it was a small check.
How did you, in terms of like the check size, fitting into the round, you say it's a small check.
Yeah.
Were they raising like $500K, $1 million, and you put in $10K, $100K?
I can walk through just those 4 examples, right? So,
yeah, sure.
Instacart, he let me invest on a note because he had known me, and I told him that like I use a product, I really love the company, I want to start a fund, I'd love to invest. And I met him for a beer, and he like talked to me for half an hour and just asked me a bunch of questions and was like, okay. So Mike Maples has a great line about this. It's oftentimes the founders that help people like you and I get into some things. Mitchell, I had known for a year, was helping him, and it was very difficult for him to raise his round because it was just one dude. He was 21, super young.
Mitchell, which company is this?
HashiCorp.
HashiCorp. Okay.
Yeah. So Mitchell Hashimoto, I met him when he was 20.
That's hard to raise money. 20.
Yeah. And also like he had an open source project. People didn't really understand the gravity of what it would be. Now I had some asymmetric information on Mitchell because his boss was a very close friend and was like, hey, he's really exceptional. Can you help him out? So I'd help him out on something a year before that. And I'd met him a couple times, and it was extremely evident that he was not a normal 20-year-old. So I stayed very close. And then when I was helping him, I didn't know I would raise a fund. So when he was doing this, I was like begging him. What little did I know, it was like impossible for him to raise a round. So he only raised $575,000. It was me, his boss, who was my friend, and then Puneet from True. That was a very good decision by Puneet.
Do you know the numbers on that one for you or for them?
Yeah, I mean, people can back into it, but it's sort of a public company now. So the round was $575,000 at 3.75 million post. There were not a lot of other people, I think, wanting to invest. It was just Mitchell, and Puneet did like the majority of that 500K slug.
So, I mean, what happened next? You've done these 4.
So where I was going with that is I thought in a year or two, like Gautam was telling me, is take that track record, take it back to the funds,
Did you? What did they say?
So that was 2013. In 2015, I got a number of, I would say like junior partner offers or principal offers, whatever the term would be. So they were like, okay, we see the track record because we had an insane number of markups in the first 2 funds. This was like a markup like hit rate. I didn't even know actually that it was like a good thing.
What did you think? Were you still like, I don't know if this is any good? Like,
no, I just had no idea. Like I would get a call and be like, oh, so-and-so's looking at this and they're going to mark it up. I'm like, what does that mean?
So what did you do with that information?
Nothing. I got the offers, and then, I credit Glenn Solomon from GGV, who I had known for a while. And a lot of the people who invested in those first two funds were a lot of the VCs or managing directors or founders of other funds you would recognize.
Mhm.
So I had access to all those people, and they were very supportive of me. So I was grateful. So Glenn pulled me aside and said, "Hey, your little thing is working. Turn over some more cards. Don't just give it up. And if you want, come sit with us as a venture partner," because those first 2 years I was sitting with Paul Martino at Bullpen. So he was very kind. When I started doing the fund, I had to consolidate a lot of that. So I asked Paul, "Can I be a venture partner with you?" And he was like, "Yeah." Paul's amazing.
So what does that mean? You're a venture partner. This partner, it sounds like you're part of the fund. How does that work?
I think it's different at every fund. So Paul is very open, loyal, transparent. They have their partner meetings on Fridays. So I would always go meet them on Friday.
In Bay Area somewhere? Or?
It was either in San Francisco or mostly on Sand Hill Road. They had an office there. And, they were just really open. So I'd go there, hang out every Friday morning into the early afternoon, get lunch. It was great. And just, in the 10 years, and we can talk about this, I've been sitting in other partner meetings for 10 years.
Yeah.
So the first 2 years was Bullpen with Duncan, Rich, and Paul. Then Glenn, made that overture, a very generous overture. So I sat in the GGV meetings for 3 years as a venture partner there doing funds 3 and 4.
That was GGV Fund 3 or 4, or that was
Haystack.
Okay.
Funds 3 and 4. Yeah. When I started doing Haystack 5, that is a longer story, but the folks at Lightspeed, who some of the founders had been investors in the fund and had known me, we could talk about that later. But there were multiple times where people have come to me 2015 and then after for like full-time role or leadership role. I guess the short answer, which is the personal answer, which is the most honest answer, is that I really wrestled with that because financially it would have been immediately rewarding and game-changing. We're talking like counting zeros. Yeah,
Okay.
Right? By that point, when those offers got more serious after 2015, I had already become acclimated to like doing my own thing, making my own decisions, structuring my day the way I want to. And when you go in some of these places, you don't really have that. You don't have that ability because you have to work with everybody else. And so I kind of just decided that like, even though the zeros, and by the way, in 2015, my wife was pregnant with twins.
How many kids do you have now?
I have 3.
Okay. Personal things going on too.
So until 2018, I was literally living month to month.
Until 2018?
Until 2018.
Okay. When were you, I know what some people do is they don't charge management fees on small early funds. Like how did that all play out? Like how did you survive?
Yeah.
Like,
And I hope we can really get into this topic because I think there's a lot of like philosophical lessons in here. So pre that Haystack check, that first one, the first Haystack check in March of 2013, I was hustling hard. I was collecting multiple paychecks as a consultant per month and scrambling.
was your wife also working in some
Yes.
capacity? Okay.
Yes.
Did that stop with the kid? Because that wasn't, for me personally, that was
Yeah.
like my wife wasn't working anymore. I had to figure
Yeah.
things out. Like, were you
Well,
similar?
I mean, that's jumping ahead to 2018. So she
Okay.
stopped working in 2018 when our oldest was entering kindergarten, and she really wanted to like be the parent, mom, picking up the kid from school and having that experience.
Yeah, which is really important. Like, I think that's
It's
really
a
big choice.
it's a personal choice. By that point though, I wasn't thinking month to month. But it only just happened. Like it's almost celestial now as I think about it, like the lineup of those things.
Yeah.
But it wasn't like planned. To your original question, like, hey, how did you make money to live here? So 2010 to 2013 basically was a mix of consulting roles. I consulted with companies, worked at some companies. There were a couple of exits. This is not stuff you can bank on. And then, I was collecting small checks from VC funds every month. Very small, like I would say a token amount, but enough to like keep the engine going. You know?
You get a couple of those, it's enough to pay rent.
Yeah, absolutely. And if you go to enough like VC events and like networking events, they have food there.
Sometimes it's really good too.
You go to like a dinner at Tamarind, you're like, that's pretty good.
Yeah, and well, I know like now you're hosting some of those events, and you'll invite me. You're like, man, that was a good deal.
Yeah,
this was good food.
Yeah. Well, I've learned in doing events, my philosophy is if you have either one of the following, which is really good food, really good company, or a memorable location, people will be happy.
What if you do all three? That's the trifecta?
All three is a trifecta, but would you really do that? Maybe you would. I don't know.
I feel like that's if you've got the fund size to support getting all those things checked.
Yeah.
Okay.
So that first 3 years was just cobbled together. 2013 onward consolidated where I was a venture partner at Bullpen. So I earned some consulting income there. And, that kept me afloat basically. And I did not charge management fees in the first fund. I mean, it's $1 million.
It wouldn't have been a lot of money. It would have been $200K total probably if you did the typical, and that's over 10 years, like $20K a year, right? That's not.
Yeah.
It's hard to live off of that.
Yeah. So there was no fee. And then the second fund was 3.2 million. And I think the fee was like really small. So again, it's the same issue.
So how did LPs think about, you're starting to build this real institutional fund, or maybe they didn't think of it that way, but you were starting to think of this as like a serious thing now. How do they appreciate, he's doing all these other jobs?
Yeah. So I don't know if I would accept the premise of that question. I would twist it a little bit, which is Fund 3 was the first time I thought I would go out to raise 20 million and talk to some family offices and people I know. And, I had the slide in the slide deck. I still can picture it for that Fund 3 deck of like all the VCs that invested in my funds.
Yeah.
Like
that's
they
a
would
classic
give a shit
slide.
about the classic slide. Like anyone would care at the end of the day. So that was the first time. I wouldn't say I was trying to make it institutional. I was trying to get some lumpy checks, but I wasn't trying to present as an institutional investor. That was not a goal. But I would say that time frame was kind of 2015.
Well, so the first fund?
Yeah, 2015.
The first fund was $1 million.
Yes.
2013
vintage.
Okay.
Say, yeah.
And then you invested over what time period?
It was about a year and a half.
Okay.
Then Fund 2 was about a year. It was like really fast.
Interesting. Okay.
Yeah,
so it was like everybody in 21.
Yeah, except that this fund was a screamer.
Was a screamer? What does that mean?
It had a lot of things that popped.
Okay.
So it had a lot of like small cap, like sub-$1 billion acquisitions to just pay back the principal.
Oh, very cool.
And then it had some asymmetric outcomes.
Filecoin, I think you've mentioned that.
Yes.
Company. That was in that one?
Yes.
Okay. So
Yes.
that was 2014-ish. It was a $3 million fund?
Yeah, 3.2.
Was it pretty much the same process of Fund 1? Like, was it like, hey, deployed the capital, the markups, do you guys want to do the next one? Was it new LPs? What was the process?
Yeah, it was like, I always think of like a Jeff Richards from GGV as canonical example. Jeff is like super supportive person, was like, oh, I'm going to do 25 or 50 in every fund, and then introduce you to like 35 people I know. And like 17 of the 35 people were like, sure.
Wow.
That's the great part of living here. If you're around people and they trust you and they don't think you're trying to like do too much and you're coming at it with like an earnest approach.
So what is doing too much in this case? Is this like raising too much money?
Raising too much money or like being too cute about it, or actually just not presenting. Like one of the reasons I like working with you and spending time with you is like your earnestness level is like off the charts. So I just think when people sense the earnestness in others here, they're looking for ways to help out. Whether consciously or subconsciously. It's probably helpful to define like what does earnest mean in this context. I think it means like learning mindset, humble. I'm here to serve you. Like, what can I do to help? I know that sounds cliche. Actually following up on it.
Yeah. The biggest thing I've learned with that is you don't ask, how can I be helpful? You just figure out what they need and you just try to do it. And sometimes you can and can't, and that's okay. But it's just, you really just try to figure out, and it might not be a lot.
Sometimes it is just spending time with the person who wants to talk.
Yeah, that's true. Yeah. I think the first time we met in person, I was going back and looking at our DMs on Twitter. We must have talked publicly, because I looked at our DMs and my first DM was, hey, I'm going to be in San Francisco, want to meet up or something. It was not, there was probably other context.
No, I mean, I think you've done an amazing job at like reaching out to people and using Twitter. I don't know how you do it, but it's awesome.
Honestly, I don't really know either. I'm still learning how to do it. So, but it's fun. Also, another question with the fund structures. A lot of times when you're talking to people, you're trying, like specifically more institutional LPs, trying to make the jump to slightly larger fund sizes, you go from I'm doing this proof of concept to get a job at another fund to I'm actually doing my own thing. There's all these rules on how to do portfolio construction, all that stuff. Based on what I've heard you say previously, you kind of changed the funds. Like they're all a little bit different. And like, you've talked about how I didn't even know what some of these words were that people were asking me to talk about. How did you approach those, learn about those?
A third was the earnestness of just trying to be like, oh, what is that? Ask other friends in the ecosystem and ask the Jeff Richards or Puneets of the world. What is this? I think a third was spending time with LPs and actually listening. Like, okay, this isn't going to happen, but this is another person on the other side of the table. We have some connections around some things and they're telling me things. If they're going to spend time or give me feedback, really pay attention to it. And I think the third was just the sort of cultural assimilation of sitting inside these partner meetings, which I was very fortunate, and still am very fortunate to be inside those meetings for years, where you get the kind of slow osmosis coming in. But the portfolio construction, I think, is the big thing, because if you kind of step back and think about what an LP is buying when they're investing in a fund, let's say with like a $3-5 million check in a small fund, right? And they're investing in the blind pool. I believe more philosophically that the product of a VC fund is actually an investment decision. And so those investment decisions are bundled into one blind pool product, which is the fund vintage that they're investing in. And if they don't trust that you're going to get the geometry of that right, or even just think about the geometry, they're probably going to say, I'll wait till you figure that out.
Yeah. And I think you said before, this is the number that you said, with a $40 million fund, ownership starts to become more important. I forget, maybe you had a number here, but
yeah, 40 to 50, yeah.
So like if you have $1 million fund, it doesn't really matter. If you have a 5 million, 10, like how do you think about
I think there are a lot of rules of thumb on this, and I don't know which one's the right one, so I'll give you a few. The one I always use is 0 to 20, 20 to 40, 40 to 100, 100 plus. There's some ownership band in there, like 0 to 20 probably doesn't really matter. 20 to 40, I think, is kind of coming up on 5%.
It's tricky, yeah.
Maybe even 10%.
It's also then about how concentrated and how many checks you want to do.
Yes. Yeah, because the dilution can be pretty severe, especially in the last cycle was very severe. And then 40 to 100, I'm probably more conservative on this band, where I'm like, kind of need 15 to 20 points of ownership, which is so hard to get, right? Most good founders don't want to give that up right away. And over 100, I just think, you start approaching benchmark model, honestly. Yeah. So everyone, I think, just assumes they may have a hit rate like Union Square Ventures, and it just ain't the case. So that's one school of thought. There's another school of thought, like if you follow Michael Kim and those folks at Sindona Capital, they've done a lot of great work around it. And I know a lot of LPs pay attention to this metric, which is, what is your entry ownership to fund size ratio?
Can you explain that ratio?
So like, what is, if you look at someone's portfolio, or look at Banana too, and I would say, okay, what's the size of the fund? Okay, X. What's the median entry ownership that Turner gets? I'm going to score that against other funds I'm looking at, because at the end of the day, assuming a decent quality pool to select from in terms of like their networks and what they're going to bring in, you kind of want to know that like you're getting as much ownership as the LP for the fund size that they're getting.
So it's essentially the smaller the fund and the higher the ownership leads to a better ratio.
I think it's an attractive metric that sophisticated LPs pay attention to.
Yeah.
Because at the end of the day, they're buying into the blind pool, and they want to have the ownership because they know the power law rules a day on these funds.
So then how did you start to get more ownership? Like you were talking about 25K check. These companies are now worth $100 billion or what? Like, I mean, some of these companies that you invested in, like, I don't know. I guess I don't know what DoorDash is trading at today, but these are big, real companies that are doing billions of dollars in revenue. They're real businesses. They're very big. How did you go from 25K to, I guess now you probably need to get closer to $1 million, $2 million, $3 million?
Yeah, that's been a journey. So I think now officially, if you look at the record, Haystack's been investing for over a decade now, technically. But I always credit Chris Duvos, who's I think Ahoy now, for this. Chris spent a lot of time with me early, some of that Palo Alto magic. But he had a great line, which is just crawl, walk, run. And what that meant in this context was like, just slowly escalate your check size. So like the first fund was 25K checks. The second fund was like 50 to 100K checks. The third fund was 100 to 250K checks with a couple of like big top ups. Fourth fund was kind of $500 to $1 million checks. So that was the first time I wrote $1 million check. Fifth fund started writing $1 million checks. Sixth one's $1 million check. Seventh fund, we can talk about that later, but it'll be $1 million checks. At a certain point, if you look at our data, like one of the things I'm really proud of, if you look over the 10 years, it's like 270 something companies, right? Something like that. I don't know. Just say it's 275 to 300 companies in a 10-year period. If you were to scatter plot the median entry valuation, it really clusters around 8 to 12 million over that 10-year period. And we've participated. The reason I'm proud of that is we participated in the same rounds, but we've just taken more share of those rounds slowly. That was kind of how, channeling Duvos was to crawl, walk, run. We're in run mode now.
What does that mean? Run is just the larger checks, or you're in stride. You're a real institutional firm.
Yeah, I mean, I don't think anyone cares about that. I think it's more that we can play more offense and like write $1 million check, lose $1 million check on a deal. Like it's okay. we can take our shots and live and die by them.
Talking through the rest of the funds as they evolved, we were kind of at fund 2 and then to 3.
Yeah.
So I think you went from 3.2 to
8.2.
8.2. Okay.
Correct.
Those are not round numbers. Like, were those the numbers you were trying to get to? Or
No. Every fund until fund 5 was always below the target.
Interesting. How did that happen? I mean, how did that make you feel? It seemed like you have a great portfolio.
Mm-hmm.
Like, why didn't you hit the targets?
Just hard to raise capital. I think you could look at it and say, hey, when I tried to raise fund 3, the number was 20 million. This was going back to the first time I was trying to get lumpy checks. And you have a goal. Like it's like if you're at a company and you're like, we're going to do 20 million ARR in the first year, and you don't hit the goal, but you get to 14. Not bad. So I didn't, in the third fund, I was like, well, this is just what it's going to be, whatever. But that company will have like $3 to $5 billion outcomes in it, and one that could be like a 30 to 50 plus billion dollar outcome.
So really quick, can you explain why that matters for someone who doesn't really understand this? Like, why is that a big deal with the size of the fund and the outcome and?
Well, yeah, because like in the moment or in that more immediate sense, you could view that as a failure.
Because you didn't raise as much money.
You didn't raise as much money.
Yeah.
You could view it as a failure. That's one lens. You could view it as the second lens is the market spoke and the market speaks.
Yeah.
That's a second lens. You could view it in a third lens of like, oh, my hurdle to pay back the fund is lower and I can maybe raise the next fund sooner. There's no rules around when you can raise these things. So it's sort of like a founder saying, hey, I was trying to raise $1 million. I got to 600K. I'm just going to go back and then go back earlier.
Yeah. And do you think let's say it happens to me, like, should I be sad about it, discouraged? Like, how should I process it? Like, how did you
process
think
what?
Just like I was trying to get to 20 million. I only raised 8.2. Because I feel like we do sort of glamorize some of these things. And I think some of that's a good thing, but I think some of it's actually, we should appreciate a little more. It's not really failure.
We can talk about this after, but the fund 4 is where I felt the most fear and pain. It wasn't fund 3.
When you say after, you're saying in like a couple minutes, we'll talk about it?
Sure.
Yeah. Okay.
I guess what I would say in a more blanket sort of generalized statement is, number one, when people are investing in Banana or Haystack or the next fund to invest, they don't owe us a management fee or salary. I think there are a ton of people I've met. I would go so far as to say like hundreds, who are like, I need to raise this amount in order to have a salary. And I'm always like, do you deserve a salary?
Yeah, that's a good way to think about it. How do you earn the salary?
Open question. But I think a lot of people just assume.
How do you think about if I'm starting my first fund ever today, or maybe I did my first fund in 21, I'm doing my second fund right now. How should I think about what I go out to do? How big the fund is, backing into the salary number? Like, how should I think about approaching that right now?
I approach it at times almost like, what's the first step or step 0 is I wouldn't even attempt it as a full-time gig unless you have a capital partner ready to go to anchor a good chunk of it. Otherwise, you're just going to waste your time.
One of the things you've mentioned before is pre-marketing or pre-raising the fund. That's what I always did. I just don't really like fundraising. I feel like the best thing to do is get everyone committed and then actually take the money. There's less pressure. Is that a good way to approach it?
A good founder, I think, is always fundraising. Now, there's different degrees of what fundraising metal they have at a certain time, but they're always doing it. I think the same has to be true of a person who's leading a fund and on the hook for getting the capital in the fund. It is super hard. Founders don't have no clue how difficult it is for you to raise capital, but then they expect you to give it to them.
What do you think founders should appreciate about raising a fund? Why is it so hard? Why do they not understand how hard it is?
Well, they don't care.
It's just, we're a big fund. We have $1 billion.
Some do. I don't want to say, like, a lot of the people when we back them, I wouldn't say everyone, but as part of the discussion, I always tell them for 3 minutes, like, hey, here's how this started. Partially to just level set of like, oh, I've actually raised a lot of money over successive rounds. Like, and I know how helped a lot of companies raise funds. So I know what it's like to go through that. But I think a lot of founders, when they meet investors, for the most part, a lot of them haven't raised their own rounds of capital.
The investors that they're talking to. Yeah,
yes.
That's true. And I think it actually, people get canceled for saying that being a fund manager is like being a startup founder. It's not the same, but there are some parallels.
It's definitely not the same. I mean, the stress is definitely not the same.
Yeah, it's different stress, I would say. And it's not the same level.
It's different, but I still think in the capital raising mode, or when you put your face and your name out there, there is a parallel there.
Maybe we can get a little bit back to the pre-marketing strategy. But
Sure.
So fund 3, it was 8.2.
Mhm.
Did you start? Because I think I'm actually, currently going through like you started investing the fund and changing the size of the fund as you started investing. Did you start deploying the fund as if it was going to be your target, or did you raise all the money, hit 8.2, and then you were going? Like, did you?
No, from January of 2013 until the summer of 2017, whatever that is, like 4.5 years.
Okay, that's a long time. This is the 3 funds, the first 3 funds.
Kind of 4, raised 4. I was continually fundraising and investing in founders continuously over those 4.5 years, with the exception of a 6-month break I took.
Did you just have like $2 million that you could sit on and you didn't have to raise?
Something like that.
Okay.
But those 4 years, so technically I would say for 4 years, non-contiguous, was constantly every day meeting someone to get $50K, and then maybe that evening turning around and spending $50K.
Yeah. Did you ever have like a wait list where it was like you had 3 founders that you owed some money to, and it was like, I'll send it to you in 3 weeks. I just got to raise it?
No, I always tell the story about Ironclad. There were a few of these, but Ironclad was my favorite, where I was fighting to get into the seed round. I really liked Jason. This was at the beginning of Fund 3, and so I had not closed some of it yet, and I wasn't sure when it was going to come in. This is the $8.2 million fund.
Mm-hmm.
And my wife was pregnant, very pregnant with twins. So we were about to go from 1 to 3 kids. And I was still living month to month. This is the fall of 2015. So I remember like fighting to get the allocation. Jason was extremely gracious, as he always is. And then I explained, do you mind if I wire it in a month? This is the situation. So I wrote out the whole situation. And Jason just wrote back and said, sounds like a lot, no problem.
So it's just communicating and just letting the founders know. Yeah.
Yep. And again, it goes back to the Maples line, right? Where Jason, and I've had founders do this on occasion too, where we ask, I'd ask like a week or 2 later, can we wire? And they just are like, sorry, can't. I don't fault him for it. It is what it is. But Jason, to the Maples point, was like, yeah, he created the opportunity for me at the end of the day.
Also, I think as a founder, it's when you talk to a lot of people, it's just like, I just want to get this done. I want the cash in the bank and be out of fundraising mode. So I can appreciate that. I can't wait a month. I'm sorry.
Yeah.
Tough.
Yeah. No, Jason was raising like, I think $2 million. So the $100K I was offering him, I think.
Yeah.
He knew he could get the other if it fell through.
People who are not really, if they've never raised money before, you don't have to have a fundraising event. Like you can just meet someone, they want to give you a certain check, and you can just take it.
When I started investing, most entrepreneurs were cobbling safe notes together. That was the sort of standard. At some point in 2016, 2017, people just decided they probably read enough TechCrunch articles where they'd say, oh, I have an idea and I'm going to raise a $2 to $4 million seed round. And a lot of them didn't raise those rounds because people were like, well, I have much better flow for 2 to 4 million of like seeing actual proof, or like no cold start problem. But that became sort of something I think people expected.
From the founders were raising 2 to 4?
Yeah, they were just out of the gate. And it's still happening today, right? There are different reasons why it's happening today, but
okay,
you were wanting to talk about pre-marketing.
Yeah, well, I guess, so we're on Fund 4 now, right? So you went from 8.5 to, what was Fund 4?
8.2 to 22.8.
Oh, so again, did you?
Nope.
What happened with Fund 4?
It was the first time got like legitimate institutional foundation checks.
So how big were some of those?
5 million, 3 million, 3 million.
Oh, so it's in people who really went to bat and say, we'll be 10, 20, 30% of this fund.
Yeah.
And when did you meet those people? Did you meet them and they sent you the money the next day, or how did that work?
No, I met them through the Fund 4 process. Took about anywhere from 1 to 2 months to the full 6 months.
That's not that bad. It sounds like a lot, but that's pretty good. Yeah.
Yeah, no. I know a lot of people today would be like, ugh, but that's pretty standard, I think.
Well, so then how did you approach, and maybe this is a little bit more of like, maybe you've learned a lot, not necessarily what you did with Fund 4, but how do you approach building relationships with LPs? Yeah,
that's another big question. I mean, I feel like I've done a good job at that. I think in Fund 3, when I was trying to raise 20 and got to 8.2, I kind of quickly realized that like, oh shit, a lot of these people are never going to invest in this fund. But we had a number of like mutual connection points, or they were LPs at GGV or at Andreessen or at Lightspeed. And I knew a lot of people there. So I just kept my notebook with me and did little things, tried to help them out, tried to help them get in a fund, tried to help them see SPVs, tried to help them take feedback. Like a lot of them would spend time with me. So I just built up a network. I started emailing out other funds to them. So I started like, I don't want to say it's a newsletter, but it's like a Google list. And then we started, you've been to the Alignment Summit, right? So that's kind of my like pay it forward thing for the ecosystem in terms of managers, where I felt like a lot of people like Puneet, Glenn, Jeff, etc. Paul had helped me. Hundreds of people helped me, but I can't go pay those people back. So then it's like, okay, well, I know all the LPs now. I know a bunch of GPs, like just host a curated, tight annual event for those folks and put them in the room together.
Yeah, they're really good events too. I guess I've only been to the one this
but
year.
I spend time with them. They do appreciate like candor. I think they appreciate having time to get to know you, reference you, see how you change.
Yeah, that's a good point. See how you change, because that's what an investor is looking for. Like venture capital is looking for in a startup. They're looking for that rate of change, the progress, the lines, not dots.
Yes.
And LP is really looking, a limited partner. Those are people who invest in venture funds. They're looking for the same thing, really.
And you know this too. I didn't really appreciate how heavy the referencing is.
Yeah.
It's just insane. Now some of it's like silly because it's like, they really want to, like, all they can do is diligence. So it's like, let me fill my week with diligence. It's like, what does Turner do? Oh, you're by your 19th call. Like, what are you trying to uncover? But at the same time, it is important to reference, right? So you have to be referenceable. And there are just a lot of people who are not referenceable. And if you're trying to be a VC and you're not referenceable, then almost by default, you probably shouldn't be doing it.
How do you become referenceable? Or in other words, what are the LPs looking for when they're doing references? Do you know what they ask?
You'd have to really ask them. I mean, I guess I've taken a bunch of reference calls so I can like sort of synthesize what they're looking for. It's sort of like, I took one for a good friend last week. Actually just told me today he got a $10 million commitment right after that call.
Wow. So you know what you're doing with these reference calls.
Well, I mean, I'm trying to play it very fair. I usually say like, if you want X, Y, or Z, like, or what you're buying, like, and you want this, you should do it. I think they're looking for, when they call me for a reference, which is my only frame of reference on this, is how do you know the person? Do you share deals with them? Do they share deals back with you? How do they find deals? What would you describe as like a superpower that they have? Any interpersonal issues? What's their behavior like? Why do founders want to work with them? It's those kind of questions, right?
So some of those rhyme with what they might actually ask the manager that they're looking to invest in, and it's a reference or just making sure the story lines up. Almost.
Yeah, because they know that most VCs, when they're talking to them, are just like full of shit, right?
Yeah, I think I was really bad at that initially. Like I didn't brag at all, and I think I undersold myself. I think maybe I'm getting better at it, but
I think over time you'll be rewarded by that, because at the end of the day, like nobody knows, like none of us know what we're doing. We don't know what's going to happen to the companies. And I think just almost blurting that out and saying like, here's how we're going to manage the uncertainty around it is refreshing. Also, it's better to have other people talk about you, I think, over the long term than you to be talking about yourself. Like I think as a VC, for every 60 minutes you speak should be like 1 minute of like full on marketing yourself. And then after that, it should be 59 minutes of storytelling and having other people tell your story.
That's fair. I've noticed that the storytelling really helps with LPs. Like you just tell them, they basically, like for me, it's like they just ask about the hottest markups or the best companies, how I found them, how I got into them, what I did. And it's the same question. So I've kind of just started to weave it into the narrative and the pitch, and just I try to push it a little bit because I know they're going to ask it. I know it's helpful. So
I think it's like a timeless thing. Is people, we remember stories. They're like, oh, I took a red eye to Houston to go to this event to like meet this founder.
Yeah, and I got in front and we led the round because of I introduced them to some customers that were at the event that they closed, and
yeah, just the little things.
So the 2.2 or 22.8 million. You had your first couple big institutional checks. Was this, and you said this was the hardest? I think you mentioned earlier. This was the hardest one to get done.
That's when the most fear set in.
Okay, what was scary?
There were two episodes where I was like struck with a bolt of fear, but they were like different types of bolts. So I started in January and I was going to try to go to the end of June.
This was 2018?
2017.
2017. Okay.
2017, and raise, like a $30 million fund. There's like a top tier venture firm on Sand Hill Road where, they have it doesn't matter what the name is, but like one of the main figureheads of that fund is a very well-known, powerful person who has been a great friend, partner, mentor to me, and said, any LP you want, I'll intro you. So I just said, hey, I'm not going to do that. But if I ask for one bullet a year, will you fire one bullet? He was like, oh, yeah.
What's a bullet? Just one?
Like a really nice intro.
Just a single.
Yeah. Because he was like, I can do 10, 20, this, whatever you want. And I'm like, well, I'd rather amortize the bullets over time because I don't know when I'm going to need them.
Yeah. You might use all those bullets to have no ammo
So
left.
the first bullet I had him fire was into this university where I had met and known these folks, and I had gone to visit them, and they had done emerging managers. And it's a big university, so like I was psyched. So I'd met them earlier, and I knew they were going to be on Sand Hill Road for that firm's AGM, which was every January. And they would often invite me to the drinks portion of like the 2 or 3 day event.
That's what you do with the alignment summit. You do the AGM and then you do the summit.
Yeah. I staked out being on Sand Hill that day, and I remember emailing her. This was like the head of privates at this university. I had already gotten that reference from the megastar, and it was like a detailed one.
What does that mean, detailed?
It wasn't like, hey, you should meet Turner. It was actually like, that's what I exchanged the 10 to 20 intros for like one. I'm like, can you actually sit down and write an intro? That's what I want.
Okay.
So I sent her a note. So I'd already met her, already visited her on her turf, already had that note sent. And then another one of my really good friend mentors, she had already back. So I sent her an email like end of January. So I started January 1 or whatever. So I'm on Sand Hill Road, email her and say, hey, I know you're at the Rosewood. If you have half an hour, 45 minutes while you're here on the trip, because she has to be at the annual meeting. That's her job. Would be great to meet you. I'm right across the street. I think in about, if I had to guess, I would say 17 minutes, she wrote back and said,
that's good. That's encouraging.
Except, this is where it gets not discouraging.
Okay.
She said, sorry, too busy, sent from my iPad.
At least you got a message though.
At least I got a message. So definitely, I think that bolt of fear was like, oh shit.
What was the fear? Because you had a bunch of other
I viewed it as an omen because it was like, oh, wow, I just took 10 bullets, I squished it into one, and I fired it here, and like she didn't care.
It was a cannonball instead of a bullet, and it missed.
Oh, yeah. I don't think it missed. I think it didn't make any dent.
It just hit and bounced off.
It just bounced right off the institutional wall. And then the other fear was like more in like April or May when I had been traveling a lot. So I was like, my ass was on a plane constantly. It was like 1 week I would fly out to Dulles and then fly back. And like, I fucking hate that airport. I don't know why.
Wait, Dulles, which one's that?
In DC.
Oh, in DC. Okay.
Because then you got to drive like an hour and a half into, I don't know.
I've only been to DC once.
Yeah. I like DC. DC was great. Then I'd go to Boston, come back. Then I'd go to New York and Boston. And that's just kind of what you have to do. But then on those times on the plane coming back and you're like, oh, you're stuck at whatever 8 or 11. And when June comes, like June is a time when things just stop. I was like, man, I just sort of starting to accept it's not going to be much of a change from the last fund. But then it turned in the last 4 weeks.
Of June?
Yeah.
Okay. What changed? Because it's still vacations. 4th of July is coming up.
Honestly, I don't know what changed.
Maybe end of quarter, something like that.
No idea to this day. It was random.
So you went from you said 8 to 11 to 22?
22.8.
So you doubled it in the last 4 weeks?
It was something like that. I think like the last 3 checks amounted to like 11 or 12 million bucks.
And usually what the advice is find the anchor when the big checks first.
Yeah, I don't know who gives that advice because it actually makes no sense.
Why does it not make sense?
It's not real. The amount of people that can go start a fund and find an anchor is probably less than 1 in 1,000. So if you're keying off that advice, it's statistically not wise.
So why do people give that advice if it's just not right?
We live in an industry where people love to give advice.
It sounds good on paper.
Sounds great.
It actually makes it sound easier because it's like, oh, you have raised
and it maps to like everything you read on TechCrunch because it's like, oh, who's your lead investor?
The thing that's really interesting is people think the lead investor catalyzed it. That's why something happened. But that's not always the case, too.
I think less than 1 in 1,000, right? So if you have a partner from Benchmark spin out with a partner from Redpoint, and they're both relatively young, there's a really good chance that like very high signal LP institutions will back that fund. And if those people are in the fund, there's probably I would say 5, no more than 10, like very high signal LPs. And I don't mean there's only 5 to 10 good LPs, but I mean in the sense of like if they anchor your fund, there's like a whole smattering of people that want to co-invest with that anchor, but it's not many.
So did you have that? Did that happen for you or no?
I want to say eventually we do have a large university anchor, but that only started in Fund 5. And I had known them for over 3 years before they said yes.
Interesting. Okay.
Yes.
So you probably first met them at 2 or 3?
At 3.
Okay.
They were investors in GGV, extremely nice people, very diligent, very disciplined, very knowledgeable about early stage. So they're real craftspeople about this arcane little world. And I thought the thing that they did that was very, I think, smart and also unique is they said, hey, it was great to meet you. I'm paraphrasing in Fund 3. Definitely, we're not going to do this fund. We do have notes because we did spend some time talking about you and talking with other people. And, their job is a prospect, right, over a long horizon. So they said, when you're done with the fundraise, send us a note. And we would love to just give you some feedback on what we see, and you can take it or leave it. And so I took them up on that.
Do you remember the feedback?
Yes.
Can you share it?
I think it was the portfolio construction. Hey, can you actually really write 500K, 750K, $1 million? And then like what are your plans for the fund? And I don't think I had great answers for any of those, but it was good roadmap. But I also just remember that I think I was in the car like waiting at some park to pick up some kid. So it was just one of those memories I just remember.
Like a call.
Yeah. And I was like, oh, like this person said, call me after the fund, give me feedback. I remembered it. I did it. They honored their end of the bargain. It wasn't like a cheap call. And I was like, okay, that was cool.
That's honestly a good sign that they cared to do that.
I think they're just buttoned up that way.
One interesting story that I've heard about Benchmark is I always call and give you feedback on the pitch, which
really?
At least that's what I've heard from founders. Yeah.
I mean, it's a good technique. I mean, I'm sure like a lot of people who are listening probably follow Leo Polovets online. Leo is a very thoughtful, still waters run deep person. So I think when he spends time with the technical founders, spend time with, and he says pass, he'll write a longer note. So I do think like how you do that or how you give feedback, it creates a little bit of a brand impression because it is a touch point. And it's also over time can be a self-selector thing in the sense of like, it's showing to the founder, like I'm actually listening. And then, like I cared enough to call you for 7 minutes and just tell you. It's alarming to me how many people don't do that. I don't think you need to do it for everyone you meet. I think it's just a function of like how much time do you spend. If you ask someone for 3 or 4 meetings, I don't think you owe them a letter response, but you do owe them a response.
Yeah, you do.
And then there is a, the medium and what you say is a function of how much time you spent. Yeah.
That's true. And it's maybe part of it is that if you have 3 calls with one firm as a founder, you had 3 touch points with them.
Mm-hmm.
From the firm's perspective, it's 3 different people that spoke to you.
Yes.
So just one-off problem. So there might be a little bit of a disconnect.
That happens at big funds a lot right now.
And then, I think that's our advantage is being a smaller fund. We can just be more personal. Obviously, we can't cover as much, but we can be a little bit more intentional about what we do.
Yeah. And also it's less threatening, right? I mean, the ownership requirement itself is less threatening.
So you had this big institutional LP that came in.
Couple.
Okay. So yeah, Fund 4 to Fund 5.
Fund 5 was the first time it was technically oversubscribed.
You finally had an oversubscribed fund. That's always a good, everyone brags about that. Like that's good, right?
Yeah. I would say like the oversubscription, like the technical oversubscription happened in like the last 7 days.
Okay.
Because I think it was like, and when I mentioned this to some of those LPs, they were like, oh yeah, that's classic behavior. Like it happens.
Yeah.
I was like, oh, it was wild.
But it happens with the venture and the startup side too, where around like struggle, all of a sudden and it just happens. Yeah.
Well, yeah, but then you have a pile-on effect at the end.
Yep.
But we capped the last funds we've raised and that $50 million one that was oversubscribed. We put a hard cap on it. That's something we can talk about actually for the audience. Is my general advice is to put a self-imposed hard cap.
So why would you do that when you just want to raise? It's so hard to raise money. Just keep raise a bunch of money. What's the rationale?
This is just one man's opinion, but I think if you're asking a hospital or like a family for $3 million, they deserve the right to know within a band how much money you're going to raise because it affects the geometry of all that stuff.
Because they're slotting you into their portfolio, just like you're making a portfolio, they are. And they need to know, should our return expectations be 5 with a chance of 10x, or should it be 2 with a chance of 5x, or whatever? I always come back to this line as like, whether you're a founder or VC, like you really have to stop and think of every dollar you have, respect the dollar. Where did it come from? Why did it come to you? What are you entrusted to do with it? A lot of people don't give a shit. Yeah, it was actually really interesting. One of my LPs gave me, he told me that. He's like, the one thing you need to realize is this is other people's money. Like, this is my family's savings. I don't think that was his wording. And I really hadn't thought about it. Like, I had thought about it, but I was like, you're right. Yeah, that is actually it's a big responsibility.
The classic line for this is, in our roles as investors, we have to treat it like it's our money. But remember, it's not our money.
Yeah, it's almost harder. It makes it even more, I wouldn't say stressful, but there's just...
You're entrusted as a steward.
Yeah, you're a fiduciary.
Yeah, I think a fiduciary is more with respect to being an officer in a company. I think of this as like you're more a steward of that capital, and they're entrusting you in that blind pool.
Yeah.
So the reason I brought this up is just around the hard cap. I don't think it's fair or respectful to the dollar if you say, well, I'm going to do a $25 million fund, but because my fund got hot, I'm going to do 100.
Does that happen?
I don't know. But I'm just saying, like, I don't think that's fair.
I agree. Yeah. A lot of times I'll tell founders, like, I never really care who else is investing. And I'll say, I'm in, I'll help you raise it, but I have some parameters. And if it gets outside, I can't, I'm sorry. And I usually try to be pretty, and it's a similar situation where I think people will.
Absolutely.
Yeah. So, okay. So fund 5, 6, which one were we on?
Who knows at this point?
Okay, well, the 50 million. So it's 5.
Yeah, that was 2019, raised it.
2019. Okay. So interesting time to be starting to deploy a new fund. Was the people out of context here, the prior couple years you've been in this is always a grind. Like, it was, the money was not really flowing the same way that it was recently, but not now. So, I mean, what was that like? You started to deploy in 2019.
I had already been primed to write a couple $1 million checks, but now I was like, oh, everything. That needs to be pretty much everything. So luckily I was able to like work on that in Fund 4. Definitely made a ton of mistakes. That's always that's always the fun that keeps me up at night of like just all the mistakes I made. Oh yeah.
What was the biggest one or one of?
Well, the mistakes of omission are always bigger than the mistakes of commission.
Okay.
But there were definitely some big omissions, right?
Like what?
Where when you combine it with the mistakes of commission, it makes it more painful. But OpenSea, we passed on it 3 times. And basically, I helped Nick Tomeno raise his first fund, and we had been friends for a long time. So he was very generous and shared everything with me. And he shared the seed extension, their second seed extension, and all the graphs were going up.
So why were they raising seed extensions?
No one gave a shit about them.
And so this was 2019? Oh, no, it was 2017?
2017, 2018.
Okay. And to people who don't know, OpenSea is like the biggest NFT company.
Yeah.
Or the NFT market.
I mean, it's in a tough spot right now, but for a period in time of what that would have been, and it definitely would have provided liquidity, was a huge missed opportunity.
So 2019.
Yeah.
Getting back.
That's 50 million.
50 million.
Hard cap.
Okay.
Oversubscribed.
It's important. Everyone needs to know that.
Yeah.
So he had an oversubscribed fund.
I think the math is important. After 6 years.
We talked a little bit about pre-marketing. Did you do a lot of pre-fundraising before? Because it's a big number to get to. Like, before you actually started, where you're like, okay, I have 30 million from my existing.
At that point, my philosophy was like a quarter of pre-marketing is useful because people move slower on the LP side. They have calendars and pipelines that they're dealing with. They have fiscal years that they're dealing with. And people need reminders. I think it's almost, you are fundraising, but you just call it pre-marketing because it's like a different part of the dance. But, it's all semantics.
Yeah, I think you've used the word, it's intentional, but it's not formal.
Yes.
You're intentional about reminding people.
Correct.
Updating, keeping in the loop.
Correct.
But nothing has to happen.
Because I think a lot of what they are looking for little things in the same way you would look at a founder, let's say raising a growth round is, for example, when I set a close date, never move the close date. Never.
What if you didn't raise anything, like 10% of the target?
Well, again, this is now, I'm only doing this at this part of the game, Fund 5, Fund 6, Fund 7. But to me, it's like a signal of like, hey, we're going to be on this schedule. We've communicated the schedule. The decisioning shouldn't be that complicated if you have time. And this is what we've determined for our business to be a decent time frame, and we're going to close on this day. So I think part of it is for the capital to respect that, hey, Banana wants to close on XYZ date.
Yeah, and they probably know. If you've done a good job of meeting people and just getting to know them and them getting to know you, they probably know. I
found that repeating the close date, being really upfront about it way ahead of time, and treating the LPs like actual people, the overwhelming majority will absolutely honor the date. Whether they say yes or no is a separate question.
Yeah.
But they do honor the date.
This was Fund 5, 6, the 50, 2019.
Mm-hmm.
Did you do something in 2021?
Yeah, we raise every Q2 of an odd year.
Why Q2?
It's my little secret.
Are you going to share it, or is it?
It's the best quarter out of the 4 quarters for us to raise.
Are there things that don't work in the other quarters?
I think of Q1 as most people just don't want to make commitments in January. February is the shortest month, and then March is there. Q2 is like all kids are in school, everyone's working, everyone's trying to finish before the summer starts. Q3 is the summer and the fall has its own sort of pace and rush. And Q4 is kind of like a shit show. But all these LPs have very different fiscal years. Funds don't, we invest on like a pretty clear cadence in terms of like money out the door per month or per quarter. So I don't know if it would work for most funds.
So how did that go? The fund 6?
That was in Q2 of 2021.
2021, okay. Interesting time. Was that?
Yeah, I would say that was the easiest fundraise ever. All the LPs and a few new ones came back the same size. Yeah, and I really have to thank them all. I think because of the pandemic, because of Zoom, they weren't able to like touch and feel the portfolio and the team in the same way that they would have otherwise. So I think a lot of LPs supported a lot of VCs through the pandemic. Not that we couldn't have raised, but they let go of a lot of their process.
Of like the in-person.
Yeah. To kind of keep going. And my hope would be a lot of VCs, if they felt that from their LPs, to remember that.
And I think now it's almost the opposite, where the ease of closing a fund in 2021 and 2023 are almost opposite, maybe, or they're just a lot different.
Yeah. I always use like a Bane meme from Dark Knight Rises when this happens, where the first fundraises for me, all first 4 were so painful and so long that I'm just conditioned to expect that in every fundraise. But the majority of people who started doing this stuff, it was pretty easy. I would just say like to expect a lot of pain now, having just gone through it again.
Yeah. So how did that go? So 21 Q2,
yeah,
the 50 Q2 of 2023. That's when we're talking right now. What happened in Q2 of 2023?
Yeah, we just closed 2 new funds, basically.
2 new funds, okay.
Yeah. So we have a second product now that's like a companion fund to do very small checks in the Bs
of existing.
Look back through the portfolio. Yeah. Okay. And then it's small. And then we upped our core fund size a little bit. Ran the same campaign as the last two fundraisers. And so it was just dialing in. It's very procedural. And it happened very quickly. But I would say the questions, if I go back and look at questions I got in Fund 5, because we have a lot of the same LPs, 5, 6, 7, which, we're in an incredibly fortunate position. Small is beautiful right now. I think in 5, the questions were like pretty hard, but manageable.
Were these still portfolio construction and check size questions?
No, just the whole process. Like, how would I, on a scale of 1 to 10, like how hard was it?
Okay.
6, 7, hard on the hard spectrum. Fund 6, that was like the sort of double down during the pandemic, was like a 2. It was just like, okay.
Was it the send an email and a week later you had
No,
okay.
It wasn't like that.
I've heard
it was still
stories.
A process, but I think people were like, something I'm not going to forget is that people were like, yeah, like we're going to change our own process and let's keep going. This fundraise we just closed, I would say it happened very quickly, but the questions were considerably harder and more thorough, even after all this.
So how so? What are people asking you at this point? You've been through everything.
What I would share with the audience is less about me, but more about like, hey, what to expect or anticipate.
Mm-hmm.
If you take one thing away from this segment, it would be is like pretty much every LP for the most part is, quote, re-underwriting their decision.
Each fund?
Yes.
Yep.
So that's number 1. Number 2 is that to always remember that if Banana Capital has a relationship, I'm just picking with, let's say you have a friend at UCLA's endowment and they invest in you.
That'd be nice.
Yeah. I'd send me an email and I'll interview you. You think, oh, my friend Thomas is at UCLA. He's an investor in Banana. But actually, you have a personal relationship, contractual relationship with the University of California at Los Angeles. And so now, even if your friend Thomas at UCLA wants to invest in you, they have to go to committee. And already committees are cutting down allocation sizes, hitting pause. So that's happening. So there's re-underwriting. That means re-diligence, everything, double check everything. There's the fact that you can't push things through as easily and committees are getting tighter. And then the capital availability in the endowments and foundations here and in the traditional US sort of LP market. Of course, they have lots of money, but right now they have a liquidity problem, which is why you see a lot of people going internationally now to raise. So I definitely think we're in the early innings of all that.
Yeah.
Having just gone through that like literally weeks ago.
Which I think that could change a little bit of the LP landscape if it sticks, some of the foreign capital, good and bad.
All of our investors are US investors. We have one European life science institute That's like a academic institution. That's between Europe and the US. But that's a personal choice people make. We will definitely hear about more of global capital coming in.
Yeah.
Now, I do think like this is a little bit beyond my pay grade, but I do think there will be higher scrutiny on foreign sources of capital. I don't know how that's going to manifest. I think in the previous era, in the previous years, there used to be some social pressure or fear around taking certain types of international money. I don't think that will be there anymore.
Because there's almost no choice for some people, right?
Correct.
Yeah.
So they will bypass any fear of like social repercussions. Now there could be regulatory repercussions of it, which are, I have no idea how that's going to work.
Yeah, I guess you just have to figure out how to manage it. It's probably like a worry about it later kind of thing for a lot of people.
Correct.
Well, I guess, so you mentioned this thing called investment committee at a big LP. Can you how does that work for people who don't know?
Yeah. So like imagine you're building a relationship with an LP at a big hospital network or health foundation. The CIO there sits on the board of trustees of the whole hospital system. So they have their own investment committee meetings, and then they take the ledger to the trustees and say, like, we're going to be redoing these funds. So that CIO is putting their neck on the line.
So who are the trustees usually of a hospital? Like a local businessman,
probably like industry leaders and like the sort of community leaders, right, in business, right?
So these people probably don't know what the hot seed stage startups are.
Correct? Of course not. But think about a university. University has an investment committee. For the endowment, it usually includes the president, the CIO, whatever trustees are part of the school. They can't have like, Banana Capital showed up in like page 6 of New York Post. So they're careful about all the repercussions of that, in addition to like the cash management piece.
Yeah.
So for example, I think this will come to a head in crypto, where you could have one person at some endowment and foundation who's really believe in crypto. They could be super technical. They could have made good crypto investments. They want to continue going. And the committee is just like, no.
There's extreme headline risk.
No, I don't want to allocate to that.
Yeah.
Well, we decided as a committee, we don't want to allocate to that.
Yeah, I think it was always really fascinating to me to see, coming from the institutional LP world, I'd see all these people talking about the institutions are coming to crypto. And I was always like, I guess I'm not talking to the right institutions. I don't know.
The other thing for the larger funds I've heard is that the committees have cut allocation. So they would say, in the past, we've done 20 in your funds. We'll now do 10 just to preserve the relationship. Maybe we'll do more in the future. But
I actually laughed when I heard you answer this question.
Yes.
It was on 20 Minute VC with Harry Stebbings.
Oh, yeah.
I think it was 2016. He's like, Semil, what's the 5-year vision for Haystack? And you said, survive, still be investing in companies.
Yes.
And it's, what is that, 7 years later?
Yeah.
You survived. You're still investing.
Survived.
What's the new 5-year or 10-year, or what is Haystack? Like, what do you see for it? Where is it going to go?
I really do think it's an exciting time. I'm personally, cautious in some ways, but really excited in others, in the sense I go back to the Duvos line. The first 10 years were the crawling and walking, and now we can run. So we'll never have to worry about LP capital again. We have infrastructure set up to like, basically we just have to now invest in founders, help our ecosystem friends. That's our job. Then we have a companion fund, which goes into the Series B. So we typically try to do a seed and A check out of a core. If something graduates and we really like it, for later. And then we've built up, I would say, like a very selective SPV program with our LPs, maybe once or twice a year, to like take a bigger shot in a company. So I think that's the next 10 years. It's just doing that. And if we find the next HashiCorp, we don't just invest $25K. We start with 500 or $1 million, stick with it, and aggregate capital in the things that graduate. And now the things that graduate are going to get better and better, because the checkpoint has gotten tougher and tougher.
Yeah. Okay. So maybe for people who are just hearing us for the first time, they haven't seen the announcements, what is the latest fund?
We basically closed on a core fund of 75 million and a companion fund of 25 million. Really, nothing changes about how we work. It's just the capital's committed and there and ready to go. And it's all from, great sources that have higher missions than you and I. And so we're very fortunate to have that. And yeah, the reason I thought this would be good too is just like, I do think I saw a little bit of the tip of the spear of what a lot of people are going to experience over the next 2 or 3 years, and just sort of like providing a good warning of like, hey, how to prepare for that.
Yeah, it's going to be an interesting 2 to 3 years.
I just think it's just going to be really, really tight. There are going to be LPs who want to make commitments to people like you and me, and they just can't.
What advice would you give to somebody, the next Semil, he's doing his $1 million fund or 3, whatever they're doing right now?
I think what's different now with AngelList is that there is a function to like collect money and run these small funds or SPVs where you can kind of do it, build up a track record, but to really be thoughtful about what your track record may look like or what the logos are going to look like in 2 or 3 years. And that anyone who's looking at you in 2 or 3 years is going to ask, what check size did you write? So that you're going to be forced to maybe concentrate more capital than you would have in the past. Maybe you were comfortable writing, 100K checks or 250K checks, but now you have to write 500K checks. Like, how do you get in position to do that? How do you show like a provenance of how you found the deal, who's in it, what does it do, and what happens to it after, right? Because people are going to scrutinize like if it gets marked up or not now. I think just having the fund size capped and set at a number that fits with the person's personality, it probably solve half of everyone's problems.
And just make sure your strategy matches what you can do. You are.
Exactly.
Are there any other announcements that you just made that we should talk about right now?
Like Ashe, that's probably the big thing is like Ashe has been working at Haystack right out of college for 4 years and done such a great job. So he's now going to be a junior partner in the fund with like significant economics. And Ashe is just great job. He's so much fun to work with. And like you, super earnest, learning all the time. And, a lot of, I didn't intend to do that. It just sort of happened organically. And I thought of copying kind of the USV model, which is like when a partner comes in, they come in as a half partner, to start, do a fund cycle and then go. And, he's done, you should have him on at some point.
I should, yeah.
Probably be more interesting and more optimistic than me. But, but yeah, so that's been great. That's basically the announcement. Yeah. It's like, we got it done and we're very grateful.
Also, I wanted to give a shout out. We're in the Founders Inc. office space.
Omar and Eric.
Yeah, I don't know if you can see it. This is an awesome studio. It's kind of a hybrid venture fund community. I think they incubate some companies. It's a really cool space in the marina in San Francisco. You should check it out. I think it's f.inc is the website, or Google Founders Inc.
Yeah,
we'll throw it in
Fort
the
Mason. Yeah.
Oh, it's in Fort Mason.
Fort
okay.
Mason. Yeah.
For someone who doesn't live in San Francisco.
Okay. It's okay. It just gives you the pinpoint accuracy.
Yeah.
But no, they've been great. So thanks to Omar and Eric.
Yeah, we've got all the drinks we needed. These are incredible setup. I do have one last question.
Yeah.
I feel like you used to make and produce a lot of videos and content, and maybe you still sort of do, but you do it less. Maybe I know the answer. Maybe people know the answer, but why don't you do it quite as much anymore?
Well, I'm going to change that pretty soon. I think it's just a combination of like, having 3 kids and COVID, these funds started to really work pre-COVID and then during COVID, and then we started to make bigger investments, and then a lot of career stuff started taking off. And so I think just the pressure of like managing the work relationships plus the home life and relationships was like, man, I just don't have the time for that. I also do feel like if I'm going to write a post, I should try to fit it all into one tweet, 280 characters. And if I cannot, then to go write it. But I don't tweet storm. I don't like tweet storms.
Yeah.
If I tweet storm about like food or like a show I saw that kind of blew my mind or something.
That's true. Yeah, you do.
I don't like the tweet storms. Like, I think those are sort of mostly like not polite.
Not polite.
Yeah, I think tweet storms are like impolite.
Why do you don't think they're polite?
Because you kind of flood the zone. Most people who tweet storm, I actually don't follow.
So these are like the, ChatGPT is changing the world. 99% of people don't know how to use it. Here are some tools you should follow, like those kind of things? Or?
If something pops up curated in my feed, sure. But like the worst tweet to see like pop up is like 37 dash.
Why do people still number them? I don't think you need to number the tweets anymore.
I don't know. I think it's a cool product feature of Twitter, thanks to Mark. Mark had great tweet storms, right? That was the original sort of flood. But I just think so I don't like it. I don't like doing it to other people. And it's basically out of my feed.
Yeah, I think it's going to be interesting to see how Twitter, honestly, as someone who always used and still uses Twitter heavily, I think it's changed more in the last 6 months than ever.
I think Twitter's amazing right now, right? But I do feel like it's either put it in 280 or write it out. And most of the things I've been thinking lately, I've been forcing myself to just like, okay, what's the nugget?
That's the beauty of Twitter too. I feel like it's just small little bites. It's short form text instead of video. It's short form blog. That's why Twitter was founded.
I also think like I'm more organic about it. It's like if I feel of like writing about something, I'll just go do it. But if I don't feel it, maybe I had nothing to say.
Yeah.
And also this format's actually a little bit better in some cases, right? Rather than writing 5 posts about the things we've talked about, it's actually better for people to hear it conversationally.
Yeah, that's why I think it's interesting. Like you can read a blog post about, it takes you 30 minutes to read the story of Haystack, but it's almost like somebody could be running, maybe some people are doing the dishes right now, driving to work, and it's kind of like you're just sharing it, and it's unedited. It's pretty, I mean, we'll edit a little bit, but it's just the story. It's not polished. It will be, it's kind of polished because you probably said it hundreds of times before, but
yeah, hopefully useful.
Yeah. Hopefully people learned a lot.
Thanks for tuning into The Peel. If you want to support the show, the best ways, as always, follow us on Spotify, Apple Podcasts, subscribe on YouTube, like, comment, subscribe, leave a review, share with a friend, and listen to every single episode. If you don't want to miss a future episode, subscribe to the newsletter in the show notes, and you'll get new ones in your inbox the moment they drop. Thanks again, and congrats to Semil. Thanks to Mercury for supporting the show, and thank you for tuning in. See you next time.